In the stock market, when it's earnings season, investors tend to get very, very emotional, very, very euphoric, happy, very, very depressed, sad, disappointed. And a lot of investors treat earnings season similar to how a sports fan treats their sports team. And they have these incredible highs of thinking like everything's perfect and these incredible lows when everything's bad. And I've always seen it in sports where, you know, if a team loses, they want the coach out of there. They think the quarterback's crap, everything. But yet if the team suddenly wins the game, everything's perfect and they view everything as being right in the world, right? And when you usually get emotional in investing, it's usually a horrible decision. You've got to look at these things practically. You've got to view the bad and the good. And so what I want to take you through in this video is three core things. One, I'm going to show you the stocks I bought this morning. Two, we're going to talk about honest earnings. So I'm going to share the good and the bad with that. And three, we're going to talk about the chef, which is the most controversial of the earnings. And we'll talk about the good in that. We'll talk about the bad in that. And we're going to talk about what my plans are with that stock. Am I going to dump out of it? Am I going to buy more? Am I just going to hold? What are my views on that? We'll get into all that in this video. Very important video. Hope you guys enjoy it. Thank you everybody that subscribed to the channel as always. Okay. Now, in terms of what I bought this morning, this had nothing to do with CPI data. I put in these moves like before CPI even came out. You know, I needed to make some moves out there, just call it that. And so I bought $2,100 worth of Meta. I bought $2,000 worth of Google McDougal, $3,200 worth of Honest, $2,000 of Amazon, almost $5,000 worth of Palantir, about $7,000 worth of Fubo. Fubo was the biggest buy in that particular account because that's a position I need to build the biggest. This was all in the public account here today. So I need to get Fubo a much bigger position in that particular account. So that's why I added that one the most aggressively. Palantir is another one I need to really build out in that account over the next few months. I mean, I feel like Palantir's kind of had a kitchen sink quarter or two thrown at them. And, you know, I think I have, I would say maybe 3 months to 9 months to continue to add Palantir. That's my personal belief. We'll see what happens. Maybe I have longer than that, but that's my belief in terms of like under $10 a share. Amazon bought $2,000 worth there. Honest, you know, Amazon just is strictly like a valuation play at this time. It's trading way too cheap of a valuation compared to what the company's growth is in the future. Honest is, you know, we'll speak about Honest later in this video. Google McDougal, strictly a valuation play. Google's way undervalued right now on forward P, trailing P. I mean, you know, just incredibly undervalued stock right now. And the same exact thing with Meta. So Meta, valuation play. Google, valuation play. Honest, we'll speak about later in the video. Amazon, valuation play. Palantir, exposure to, you know, these sorts of companies, I guess you can say, is part of it. And the other part is I just believe it's significantly undervalued. And then Fubo is just a ridiculous growth opportunity that I want to be part of. And I believe they will make it through this mess. Okay. Now, let's start here with Honest, and then we'll go from there, okay? So when it came to Honest, first off, the revenue did beat. They came in at $85 million. The street was at $83 million and some change from what I saw. So that's good, okay? The other thing that's obviously really good here is 2023 first half revenue outlook is 7 to 10% growth versus the first half of 2022. That's really good. I do wonder if there's maybe even more potential upside there as we get closer to that first half. We'll see. I don't want to get too excited. Can't get too excited about anything in 2022, but that's good news. Okay, good news. So third quarter revenue growth was 2% in the quarter. Revenue growth was negatively impacted by 8 percentage points. So growth could have been like 10% due to a prior year skin and personal care rotation program with a key club retailer that did not repeat this year. I'm guessing it was some sort of special promo with probably Costco. If I had to guess, it was Costco, because I know Honest and Costco have a very close relationship that they probably had in this quarter last year that they didn't have in this particular quarter there. That's my guess, okay? Just my guess on that. I still have to listen to Honest conference call here. Third quarter consumption of Honest products grew 6%. This is something we would like to see. More people just buying the products over and over. Accelerated growth in household and wellness category, integrating Honest baby clothing into our lifestyle platform. So they're now getting into the clothing business as well. Gross margins of 30.3% reflected a 30 basis point improvement versus second quarter 2022. So And that's some progress. I mean, I wasn't really expecting a margin improvement till this quarter we're in right now, essentially, which is October, November, December, and then obviously in 2023. But, if we're already showing some improvements in margin, once again, we can't get too excited about these things, but that's a good sign. We need to see Honest's margins get better and better and better over the coming quarters and coming years here in relation to the stock. Because if that continues to happen, the company's going to get to immense profitability, obviously, right? Updates full year 2022 revenue outlook. For key digital customers, inventory adjustments, lowering week of supplies. So that hurts short term, but that's a positive thing long term. If your retailers have not much supply, then obviously it's a very healthy dynamic for you to sell in. If your retailers are loaded up on your products, then you're in a bad situation, right? Because then if your product's not moving as fast or something like that, you can't sell into them. They're maintaining their full year adjusted EBITDA outlook, reflecting positive adjusted EBITDA in the fourth quarter. 2023 first half revenue of 7 to 10%. So that's a lot of positivity there, a lot of positivity. Also, in terms of their cash balance, $41 million, which, this is less than a $300 million market cap right now. So, $41 million is a pretty substantial amount of money. And cash equivalents, short-term investments, and no debt on the balance sheet. So that's the other thing. They're in a very, very strong overall, just call it balance sheet position. The majority of our cash investment in the quarter reflected an increase in inventory to supply our strategic expansion plans, including retail distribution into 2,500 Walmart stores, as well as our purchase of inventory supporting Honest baby clothing business. We believe the company's increased investment in working capital is sufficient to support future growth of our business. Definitely a very important line you want to hear in this sort of market where capital markets, credit markets are tight. That line's extremely important, okay? Retail consumption across baby category. This is very important what I'm showing you here. I want to take a moment to show you one of the most impressive stock market related services I've come across in some time, and it's absolutely free to use with my pinned comment down there. It's called Tendies, and it allows you to see options activity with your stocks that is unusual, okay? And so right here I have it sorted through premium, but if I want to go ahead and look up a specific stock I've been buying recently, like Meta, I can see specifically any unusual options move that have been made with this stock. Tendies gives you all this options flow data for absolute free, while other services charge between $40 and $160 per month for the same data that Tendies is giving away for free. Through Brokerage Connect, you can connect your brokerage account right into Tendies. Tendies also allows you to research and keep up with all the news in relation to your stocks that you own in your portfolio. As you know, right now we're going through a very important earnings season, and through Tendies you can keep up with everything going on with earnings right now. Make sure you take full advantage of this opportunity by clicking the pinned comment down there and getting free access to everything. Thank you, Tendies. October 2nd, 2022 versus October 3rd, 2021. Honest diaper, wipes, and baby personal care products consumption grew 2%, 14%, 7%. Respectively, right? Which is outpacing the category. So 2% for diapers, right on par. Wipes grew 4% for the category, 14% for Honest. And their baby and personal care, in terms of baby and personal care for the category, declined 3%, while Honest grew 7%. So what this basically means is Honest is taking market share, and Honest is just doing a better job running their business than their competitors are because they're taking market share. So that's something that's valuable there, okay? Now, they also had a bunch of product launches. I don't need to go through all those, but if you look at those, most of those are in the beauty category, cosmetics category, which, that's a business I'm really excited about over the future years because that is a straight profit machine. And I've watched what's happened with Elf's company over time. Obviously, that being an investment of mine, that's been incredibly well, and I think Honest is my next one, just a bigger gainer in percentage terms and in dollar terms. And I think you're really going to start to see those margins hit and the profitability hit for that business. It's a much better margin business than selling diapers. I can tell you that much, and baby wipes and things like that. Okay, now. For the preliminary first half outlook, their outlooks for 2023 reflect 7 to 10% growth in the first half of this year. This takes into account retail distribution expansion that occurred in the second half of 2022 and a new round of price increases on select diapers, wipes, personal care items effective in the middle of December of 2022. Okay, so that's coming still. That hasn't even hit yet. That's really coming soon. Balanced by uncertainty, and you're going to see that play out for obviously all of 2023's numbers, which if they're going up in price, I can tell you there's a lot of inputs in Honest's business that, from what I look at, are actually going down. So they're increasing price, and I think a lot of the cost going into the business is now starting to go down. What do you think is going to happen with margins, profitability, balanced by uncertainty of the U.S. consumer spending and continued tight inventory management by retailers, which once again, this is a bad short-term thing. This is phenomenal for the long term for Honest. They're not going to have any inventory problems in the channel at all. As 2023 progresses, we anticipate lapping significant distribution gains, including pipeline shipments, as well as revenue from integrating the Honest baby clothing business, both of which occurred in the back half of 2022. We expect to provide a more detailed 2023 outlook, including gross margin, that's going to be important, and just the EBITDA when they have their earnings call in March of 2023. So, it stinks we have to wait for that, but here's my thoughts on Honest, okay? One, am I going to continue to buy Honest stock? Absolutely. Two, do I believe this company is going to continue to grow revenues? Yes. Do I believe margins will increase in 2023 for Honest? Yes. Do I believe their cash flow situation will get better in 2023? Yes. And do I think there's a possibility that they could have some profitable quarters in 2023? Yes. And so therefore I need to continue to build out this position. It's a very, in my opinion, undervalued stock with no debt on the balance sheet, $41 million of cash, and they're continuing to grow their business, right? And they're continuing to be in a situation that they're stealing market share from their competitors. And the company's trading at a price of sales of less than 1. When their competitors traded at a price of sales of 3 to 5 range. And I think over time, Honest will be valued like those other companies, especially once they reach profitability. I think they're going to be valued at a price of sales of 3 to 5 in the future. So I think this company is extraordinarily undervalued. I've been very happy with the progress they're making in the business, and I think I'm going to be much happier next year. And I can tell you the team there, which a lot of them are from Clorox, they're running this company like it's a real deal Holyfield. And I'm very excited for it. I'm going to continue to buy the stock in regards to Honest, okay? Now, we got to talk about the chef, okay? The chef. Oh boy, the chef, okay? First thing is, and I thought this was worth mentioning, right? It's been a horrible year to obviously be a chef shareholder, a year to forget, 2022. The stock's down over 70%. Now, the short sellers almost will make you feel like that's the only stock down huge this year, when in reality, like every other stock's down 50, 60, 70, 80% this year. It's been awful, right? And especially any of these growth related plays, any of the companies that went IPO or SPAC in late 2020 into 2021, all their stocks have been devastated. So it's not like the chef is the only one there. Well, they're doing bad. Like even companies like Shopify have their stocks actually done worse than the chef, which is hard to imagine, right? Meta recently was down 70%. Netflix at one point this year was down over 70%. So this isn't like this is the only company that their stock price. It's been tough year to be a chef shareholder from the business side and from the stock price side. But I just think that's important. Okay. So first off here, you can clearly tell where the chef is focused. Look at, as soon as this release happens, look what their top 2 lines are. They're targeting expense savings of approximately $30 million by year end 2023. Focused on generating positive EBITDA and operating cash flow by mid-year 2024. That shows you where the market has taken this company's focus to. Because if we go back 1 year ago, it was all about growth. We were in a very different market at that time. It was revenue growth over everything. And that was for every company in the market. It wasn't like the chef was the only stock. Every single stock. It was revenue growth, revenue growth, revenue growth. The market is 100% flipped. And now the market says, revenue growth? Talk to us about net income. Talk to us about cash flow. Talk to us about margins. That's what we'll talk about. And so it's very clear the chef's management team, they understand that now at this point in time. And that's why they're highlighting this, because they realize, oh crap, man, we can't just continue to raise money and just grow revenue to, and lose money and things like that. It's very clear where their focus is at this point in time, okay? Now, what Sam said here, he said, since going public 2 years ago, we have significantly increased our distribution and SKU counts, which is basically just products in stores, acquired new manufacturing capacity, and elevated our brand profile. Despite our success in expanding the business, the challenges in the current economic environment and the associated headwinds impacting the category have caused us to adopt a strategic shift in how we operate. We believe that the steps we announced today, in combination with ongoing expansion and efficiency initiatives, will produce annual cost savings of approximately $30 million by year-end 2023 and position us to have to achieve positive EBITDA and cash flow by or around mid-year 2024, which is obviously something that stresses all the shareholders out, because all the chef shareholders, right? It's a money-losing company, and it's a much tougher situation to try to raise money now at this point in time, take out debt, just about anything. So it is what we need to hear, honestly. It is what we need to hear, okay? Now, let me show you the bad, okay? Here is the bad. I call it the trash. First off, they're projecting revenue of 235 mil to 245 mil. Down from their guidance of 280 to 285. That's a trash number in terms of revenue there. My thoughts on this, okay? And once again, they haven't done any sort of conference call or anything like that, and we'll hear once we can get more details on that. My thought is, I wouldn't be surprised if, like Sam's Club, Costco, maybe they had some deals in the past year in the same quarter, right? Or where essentially maybe they were selling product at a loss and just doing it to basically drive attention to the brand, right? Which, when the chef was growing, it's like you need to get attention to the brand because no one ever heard of the brand before. And I wouldn't be surprised if now, because of the whole market flip, I wouldn't be surprised if they're like, yeah, we're not gonna sell those pallets of whatever at losses now at this point in time. I wouldn't be surprised, and who knows if they even were selling at losses before? We'll never know, right? But that's my opinion on that. That's my opinion on that, okay? And maybe we get some more details on that whenever they have a conference call. But that was a bad number. Now, gross margins are straight trash as well, but that was expected. Margins have been horrible for this company this entire year. And I expect gross margin to increase dramatically in 2023. And, I'll explain that here in just a moment, okay? So, when you put the pieces like this together, okay? So over the next 12 months, the company expects to realize $30 million of cost savings. They're going to have a reduced 2023 marketing expenses of approximately $15 million. Here's the thing with their marketing. I don't even know. They might have just wasted money on marketing, to be quite frank. I think they thought if we spend a bunch of money on ads or something like that, it's going to help us. The company was doing just fine before they even had ads. You know what I mean? And so they spent a bunch of money on marketing, and I'm just not so convinced it's even worked. I don't know, man. But they reduced 2023 marketing expenses to approximately $15 million to an estimated, of approximately $15 million to an estimated 12 to 17 mil, as compared to 2022 marketing expenses of $27 to $35 million. Huge difference in marketing expense there. Automation delivered savings of approximately $6 million, as compared to no such savings in 2022. Okay, savings of approximately $2 million associated with our dedicated in-house cold storage facilities, a reduction in promotional programs that are estimated to produce about $7 million in cost savings. Okay. Now, in terms of price increases, the company expects to benefit from the previously announced corporate initiatives, including its first ever price increase across its product portfolio, which just started in Q4 2022, so basically right now. In Q4 2022, launch an expanded presence in Walmart stores that will increase the brand's frozen shelf space presence from 5 to 13 SKUs and broaden the availability of these 13 SKUs from an average of 300 stores to 2,000 Walmart stores. And the scheduled 2023 introduction of new products, including the ambient grain chips, the refrigerated bars, alternative flour tortillas. We'll see how all those products do, right? That's just kind of a wait and see. We'll see, maybe they're hits and they sell great, or maybe they don't. That takes time to play out there. Getting into 2,000 Walmart stores is huge for this company, for obviously not just Q4, but obviously for the company in general in 2023. If I had to guess, I think the Walmart rollout's been slow. I think maybe they thought they would be in Walmart sooner, and I wouldn't be surprised if that's another reason why they lowered the revenue numbers as well. So I think there's many various factors there. Just my opinion, right? Right now, we don't have any concrete evidence of that. That's just my opinion on that, okay? So if you're talking about you're going up on price and you're cutting expenses, what do you think is going to happen to profitability and margins? I'm going to go out on a limb and say there's a great tick up there, right? Now, I've done some real soul searching in regards to stock over the past hour or two. And if you didn't know, years ago, I had a very failed investment of GoPro. And this was a major investment in me. It was one I talked about on the channel, and this is like, oh gosh, 2017, 2018, somewhere around there. I think I got out of it at the end of 2017 or beginning of 2018. It's a failed investment for me. Very embarrassing, very embarrassing. And I see a lot of similarities between GoPro and the Chef. And I'm like, oh my gosh, am I going to have to pull the plug on this one? And my thoughts on this is no, not going to pull the plug on this one. And I'm actually going to continue to buy this stock. And I know it sounds crazy, and maybe I am crazy, but my belief in this brand is so strong. And the thing is, with GoPro, I saw no way out. I saw no way that things were going to get better for GoPro necessarily. And all these years later, I think the stock's lower than when I sold out like years and years ago. So it was a good decision, obviously, to get out of that one and move my money elsewhere. But with the Chef, I see things getting dramatically better. And not just like over the next 5 years, but just over the next year. If we just speak about 2023, I think every metric for this company is going to increase. I think revenue, I think their brand, I think their margins, I think their cash flow is going to be in a way better spot in 2023 than 2022. I think their net loss is going to be very minimal compared to what the amount the company's lost in 2022. So what I see with the Chef and what's going to keep me in the stock and keep me buying the stock, as crazy as it sounds, is literally I expect everything to continue to get much better in 2023. And then again, much better in 2024. And that's why I'm sticking with this one and why I'm going to be buying more shares. That's my opinion on it. I don't really have anything else to add. And yeah, I mean, am I so happy about the Chef and the numbers they put up this year? Absolutely not. But I'm such a huge believer of the brand, and I'm so much of a believer of what it represents and the growth they're going to have in the future, the margins, the cash flows, the profitability. I still see this company getting to $100 million, if not several $100 million in net income over the next few years. And, the market cap's a $300 or $400 million company. So that's my thoughts. And that's about it. Much love as always, guys. Appreciate you joining me. Appreciate everybody that subscribed to the channel. And make sure you check out Tendies. That is a pinned comment down there, and see what Big Money's up to with your stocks. Much love and have a great day.